where are you? Your office looks more and more like a tenured professor. Every time I see your background.
Do I look smart? Do you want to give me your money, Eric? Because
I do. Yeah, there's a lot more framed things and books behind you, so I feel like you are incredibly intelligent and trustworthy.
Yeah, we have a townhouse. I'm in my office, but I got these lovely bookshelves. So the newspapers you see along the back wall, which I'll describe there. The first one is the Kennedy assassination. The second one is the moon landing. The third one is the Wall Street Journal on the day I was born. The 1987 flash crash. University of Tennessee National Championship year, and 9/11. So this is my Black Swan montage of like the Black Swan over my lifetime and before kind of thing. So
that's awesome. I do feel like that's a good place to start, because I feel like you have maybe thought and written more about like the antifragility, Black Swan, convexity set of ideas than most other people that I know that aren't named Talib. And I'm curious like how that changed your, I don't know, how you think about your career or your trajectory or your work or anything like that. Like why do you have those up on your wall and remind yourself constantly?
I think like, the formative adult event for me was like the global financial crisis, 2008. I apologize if anyone can hear our dog in the background. So I was in college in 2008, and it was this very like, I was like, why or how does this work? Like, I guess it was just, I didn't know anything about finance. I studied history. But it was just like, I guess it was a jarring event, right? It was like kind of this idea of like, no one knows what's going on. Like no one actually understands how this all works kind of stuff. And so, I didn't have any finance background or inclinations or anything at the time, but I just like read everything. I signed up, it's like Barry Ritholtz, who obviously is now a big thing, but he was like, I think he was like Morgan Stanley, and he was like live blogging, every day he would like come home from like the Morgan Stanley trading floor and like talk about like he was there somewhere else. And so I think that was just like a very formative event on me. I found sort of Nassim Taleb's work. The Black Swan had come out in 2007, just before that. And it just like really made sense to me, right? This view of, I'm going to call it like complex systems, but thinking about the interconnectedness and how that can cause these huge and unexpected events, and what that implies. So that was kind of the genesis for me. And then really, I don't know, the last 14, 15 years, that's the main idea that's been interesting to me and motivating my work. And it's taken a bunch of different forms in terms of like expressing that or whatever, but that's kind of always been the central idea for me.
Yeah. So if I ask you, like, what is your specific knowledge? Like, what are you uniquely like good at and excel at? Do you think, is that the answer? Is like expressing this idea of like Black Swan, surprise outcomes of complex systems?
Yeah, I think so. I guess the way I typically think about it is, my first job was in marketing. I worked in marketing and operations at a few startups and did some consulting on that. And then I mostly I run a fund now, do marketing operations roles, kind of that side of the fund, as long as with some of the investment strategy, but my partner's the main sort of investment strategy person. But I think what's that sort of mentality of how I look at the marketing and how I look at everything else, that's the lens that's unique, and kind of how I approach it differently. So yeah, I think that's sort of been the central organizing insight for me.
It's crazy that whole careers can come out of one insight well understood, or one sort of kernel of an idea. So let's, do you mind listing that? You said it has like taken a bunch of different forms. I think that's probably a good way to like talk through all of the various stuff that you've done, because I think it compiles to a really interesting sort of career trajectory. And I'd love to kind of explore like the arc of your career projects, and the big ideas that drove each one.
Yeah. So I started my career in marketing. I was a search engine optimization specialist at a marketing agency in Memphis, Tennessee, which is where I grew up. So I had a history degree. I moved home after college because I graduated into the global financial crisis with a history degree from a third-tier university, right? So like not a lot of job prospects.
Do you sound weird to yourself because your audio is messing up a little bit? You sound a little tinny. Like there might be a weird connection or something. It may be just me being tethered to my phone.
Okay. No, I mean, I guess I can't hear myself in the recording. I can just hear my
Okay.
actual
All right.
self.
Well, let's just roll.
Okay.
Sorry.
Hopefully Jenny won't kill us.
Yeah, I mean, yeah, you sound there's a lot of stuff between your local recording and me, so that's the whole point of Riverside. So
I can open Audacity or something real quick and do a sound check on my end if you want.
Yeah, maybe just record locally.
Okay.
I
so
think
Riverside is like Zencash and all, like it records the audio files locally.
Yeah, it should be. It like records locally and uploads, which is awesome. But if there's a loose cable somewhere or something, that is not great. If it's just something weird that's getting compressed, but we end up with a great file, then great.
Okay. If you don't,
It's just worth double checking before. I would hate to find out we.
Yeah, I'm with you.
Ended up with something useless.
I don't have Audacity installed on this machine. I'm just going to install it real quick and test it.
It was like a little bad for a second, and then it got worse.
All right. All right. I am testing the local audio file quality. Here we go. Sounds good on my side.
Okay. All right. Cool.
It's not tinny. I sound bad, but just in the normal way I sound bad.
Be nice to yourself.
Not in any novel way.
Okay. All right. Cool. I will assume that it is a internet related thing. And we'll roll. So okay. So sorry, you graduated roughly into the financial crisis. Job prospects were bad, but you started working in marketing and carry on from there. The manifestations of your big idea.
I bought a couple books on SEO and read them, and I built some websites and ranked them. I decided on college furniture, and I was ranking for a bunch of terms around like buying college furniture. And so I don't know, I was making $500 a month or something off this website, but I took it to a marketing agency. I was like, hey, I'm like okay at SEO. I built this college furniture website. I think it was like collegefurniture.net or something. And so that was how I kind of got my first job. And worked in marketing at another startup in California for a few years after that. And I guess kind of maybe the first incarnation of like it's called the antifragility, the complexity stuff, was I published a book in 2015. That company I was working for got sold, and it was called The End of Jobs, and it was kind of looking at the future of work, careers. And I think really it was like me trying to work out applying this idea of, I'm just going to call like complexity as a shorthand for sort of like the thing we're talking about, complex systems, this idea of like complexity to careers, right? And so I think one of the things that was interesting for me and motivating for writing that book was, I grew up in Memphis, Tennessee. I went to school at like a small school in Alabama, and all the career paths were these just like the things I knew is like, lawyer, accountant, work at Wells Fargo as a middleman. That's what that's what people were doing. They were graduating from there, and I sort of like stumbled into this marketing thing and the internet and this whole thing. And I was like, wow, like the economy isn't this like stagnant thing where like everyone's just accountants forever. It's this like really dynamic thing where it's like, I remember like telling my parents that I was like, oh, I got this job doing SEO, and they were like, what is SEO? Like, what, you know what I mean? Like this was, circa 2010 to 2011. I had like find these articles to like convince them this was a real job. Right? It's like, no, I like do these things to websites, and like it helps people find them on Google, and that's like valuable, and like people pay for that. But I'd never heard of it, and I could do that because no one had a degree in SEO, right? No one in 2008 2008 was offering SEO degrees because it wasn't a thing, right? It was totally novel. And so that was sort of the first, and kind of just like, okay, how do we take this idea of complexity and think about like how it applies to careers and how careers are changing, and kind of like to your point of leverage, like a lot of it was about like, hey, this internet thing is like pretty cool, and you can get a lot of leverage doing things here that you couldn't before, right? All these businesses that were basically serving previously unservable markets, right? I'm selling this seemingly niche product, which I couldn't open a store in, Memphis or something selling custom cat furniture. But like, if you can sell to the entire world, custom cat furniture is actually like a pretty decent business, right? Like a lot of people have cats and they want to have nice furniture to, have their litter boxes in or whatever. And
so you can finally live your dream of selling custom cat furniture.
Yeah, that actually one of the companies I worked for, we did sell custom cat furniture, so I know a fair amount about the,
no shit.
The high-end cat furniture market. Yeah.
I really thought you were just making that up. But
no, we shared parking equipment and cat furniture was our two main product lines, so it was a dynamic.
You're just living in that long tail, yeah.
Yeah, exactly. That's exactly right, though. I mean, and that was the lesson, right? It was like, wow, there's like a whole business that we sell like cat furniture and parking equipment. It's like two things I'd never even thought about in my life is like things you could make money doing or whatever. And so I guess that was kind of iteration number one. I think kind of one of the ongoing projects for me, just in general at that point, I started doing some consulting, it's like kind of similar marketing operations type stuff. And again, just like kind of taking that complexity lens to it. I think that's always been sort of the unique way I've approached things. And then over time, that just kind of branched into investing. I got interested in investing, and particularly I know like the crypto stuff. I went to a meetup. Actually, it was when I was moving to Austin. It was like spring of 2014. I was at this meetup at a coffee shop actually that I live like next door to now, and there was a guy there who worked for Rootstock, which was it's like a Bitcoin sidechain. And I was like, what's this like Bitcoin thing? And anyway, we spent like 3 hours. I had no idea what it was. He spent 3 hours explaining it to me. And I got really interested in that as well. So that's kind of been one iteration, I think. Like if you think about sort of the complexity and the system dynamics and all that sort of stuff, like crypto, Web3, Bitcoin, whatever you want to call it, is like a really interesting expression of all that.
That was and that's going to be your second book, right? You're still working on that?
Yeah, so I started work. I have a 70% done book. Okay. It was 70% done in 2019. It's still waiting around for finished.
It's a very annoying question to ask an author, I know, and I should know better. But I remember talking to you about that years ago. I mean, and it must be really hard to write about something that's evolving so quickly.
Yeah, it is. I did write like a summary. The working title of the book is Markets Reading the World. I wrote a blog post called Markets Reading the World. That was kind of a summary of what I want to talk about with the book. I guess this is like one particular rabbit hole, but there's this like kind of, I guess, subfield of economics called transaction cost economics. Like the big person everyone knows is Ronald Coase, who wrote the papers called like The Theory of the Firm or The Nature of the Firm. It was like sort of the birth of transaction cost economics. And it's like sort of very relevant to the internet and crypto because his question was like, why do we have firms? Like if markets are so efficient, shouldn't we all just be like engaging in market transactions? Why do we have these like, you can almost think of like companies as these like little socialist hierarchies within this like broader capitalist system. And his answer to that was transaction cost. That, if I'm theoretically there's 20 tasks I need done, there's one person that could do each of those the best, but the cost to search, negotiation, and enforcement are like the three major ones, right? So I have to like find the person that's going to do it. I have to like negotiate the contract for how they're going to do the thing, and I have to enforce the contract. And that was functionally prohibitively expensive, right? So it's like you don't hire a new person for every little task done. You hire someone, and even if they're not utilized 100% of the time, it's still cheaper because you don't incur those transaction costs. And so I got into that idea, sort of writing The End of Jobs, because all of a sudden the internet changed all that. Like we look at Upwork, Uber, like the whole idea of the gig economy is basically a way of saying like transaction costs went down. And so lots of work that was done via firms became being marketized, so to speak, right? And so that was kind of the idea of market reading the world. And I think if you look at crypto Web3 stuff, the whole notion of smart contracts, it just feels like an extension of that same thing to me. It's like now all of a sudden, if you think about like probably the main transaction cost the internet brought down was like search and kind of negotiation, right? So it's like I can go to Upwork and I can type Excel specialist into Upwork, and it's going to pull up 50 qualified people with specific credentials, blah, blah, blah. And then if you think about like, in a way, Upwork and Uber are really like mini nation states, right? There's like a rule of law. If you're engaging in it, like there's effectively a court system, right? Like I'm hiring someone on Upwork, we have some dispute about how that contract is enforced, and they functionally have the equivalent of a court, right? They mediate that dispute, they make some ruling, they assess damages one way or the other, and that kind of goes on. And so that was really interesting. And then I think when I saw crypto, I was like, oh, now we could do all that through this notion of like smart contracts, and we could basically lower the enforcement cost, right? It's like when I engage in some transaction with someone on the Bitcoin blockchain, the Ethereum blockchain, whatever, I have all the security guarantees that are inherent in the nature of that blockchain, right? So I'm in a sense like that is now my court of law, or that is now the some sort of enforcement mechanism for the transaction I want to do. So yeah, anyway, that was a long rambling thing, but I guess that was kind of one of the side pieces of like the complexity thing is like how these networks, how work is organized, like the sort of network structure of it, and where it goes, and then coming back to the idea of like emergence, right? Just like what new possibilities does this unlock, right? Like in the same way the internet meant you could sell cat furniture or parking equipment or whatever. I think I got really excited about the crypto stuff. It's like, oh, what new possibilities can we now unlock that I can engage in a transaction with someone that I don't know anything about. I'm not relying on any sort of trusted intermediary like an Upwork or an Uber or whoever to intermediate that transaction. It's just based on the language of the contract and the guarantees of whatever the underlying blockchain are.
Yeah, I think that transaction cost economics is a really good lens to look at crypto through. That is how I explain it to probably total lay people. Is like, hey, things that used to be expensive in analog are going to get turned into software. You've seen that happen with the internet and software the first time. It's going to now happen to transactions and financialization of things, and hopefully legal contracts, through smart contracts in a big way. It is by measure of actual impact still really, really, really early in that. But it is a very interesting time to be kind of like trying to project out 10, 20, 30 years and see what actually happens. I think I've heard you describe yourself as like a softly technologically determinist or something like that. So like starting with the technology and then thinking about all the downstream implications of it, like economically and culturally is a really interesting kind of place to start.
Yeah, that tends to be my bias. It's like a very Marxist view, right? That was Marx's idea. Obviously, like you can apply it in a lot of different ways that don't lead to Marxism. But one of the interesting ones with the crypto, the example I was thinking about is like the idea of a vending machine. I think Nick Szabo has like a piece on this where he talks about like a vending machine unlocks an area of economic activity that was previously not viable, right? So like you put a vending machine in a hotel, you couldn't afford to like staff a convenience store in like Motel 6, right? Like you wouldn't make enough sales to justify having someone be there, and they have to open the shop up and drive to work, and you got to pay them for that and blah, blah, blah. But it like works fine as a vending machine, right? Because like 20 people a day come and like buy a bag of chips or some peanuts. And the vending machine is functionally a smart contract, right? I put a quarter in, I press Coca-Cola, that initiates a transaction, it checks that the quarter was received, it dispenses the Coca-Cola, and then there's that big lock on the side that keeps you from stealing the quarter, so that it's sufficiently. Those are the security guarantees of the vending machine. Which is that vending machines are not super exciting, but it's like I think it's kind of like the internet. It's like all these niches that just weren't economically viable previously, suddenly became viable. And like in aggregate, that was huge, right? I think it's been a while since I looked at the stats, but like over 50% of Amazon sales are from third-party sellers, which is to say like not stuff they're stocking or that like a Walmart would stock from Procter & Gamble or Johnson & Johnson, right? It's like these people selling weird bespoke dog collars or whatever that in aggregate ends up being a lot.
I was just looking up the long tail. I was looking up like a stuffed animal scale phone case because I thought it would be really nice to like, instead of like pinching your phone against your shoulder, like just have a whole stuffed animal there. It'd be like really easy. Makes sense. Or like hold that in your phone instead of like cramping your hand around like a tiny. So yeah, I live in that long tail.
I mean, we all do now. That's what it is. We are all weird.
Let's us all be the free weirdos that we want to be. Let's go back for a second to your first book, because I think that I've had a similar experience in the sense of like you have an inkling. Like I guess how much of that book did you learn as you wrote? As you were kind of like, I feel like I'm squinting and I can see something and I need to like figure it out, and you're like writing your way towards something. And you ended up kind of like writing the playbook for the rest of your career, right? Like, I feel like you started to describe that and then we went off in a different direction, but I think that's such an interesting thing.
Yeah, I think it was just such like a novel. I mean, just working with these internet businesses, I just wanted to like explain it to, my friends from growing up, really, right? It's like, hey, like the world doesn't work exactly like we all thought it worked. It actually works. There's these kind of new, different things you can do. And so I knew there was something interesting there. And it was like the long tail, I read a bunch about that. And so I had some sort of like inklings of what it was. But for me, for sure, writing is very much like a figure it out as you go along process. I was like trying to figure out, what it meant and how it worked and all that kind of stuff. So it was definitely sort of an emergent phenomenon, if you will.
Yeah. And was that book, publishing that book, a big, I don't know, inflection point in your career or how it worked? It was like your first product, right? It sounded like you were consulting and working pretty much before that.
That's right. Yeah. I was like doing consulting stuff at the time, and that was the first sort of product. It was definitely a big inflection point. I think it was, I guess it put me on the map in some way with a certain subset of people. And I think probably gave me a lot of confidence that I could like about my writing and just general career stuff. I was like, oh, this worked, right? Like I sold a decent number of copies of this thing and people liked it. And, so I think a big thing in that sense. And I think too, it was definitely the jumpstart for sort of my, I guess I had a blog at the time. I want to say I had like 250 subscribers or something, right? So it was like mostly buddies, So it's like, there's like my friends from college and like people I, like loose professional contacts. Yeah. And, right. And I went to like 15,000 overnight. I was like, wow, that's a lot of people. That's cool. What should I do? So it was a big inflection point for me in that sense. I was like, okay, there's sort of like a community here or an audience, and wanted to sort of like nurture that and make something of that and like build that out as an asset. So I think I saw one of the companies that I worked for, the founders had a podcast, and I just like saw how powerful that was. Like I looked at their podcast and all the things that accomplished for them and the people they met and the doors that opened. And I was like, and this was, it was like one of the top 10 business podcasts at the time, because like it was 2012, right? No one had a podcast.
There were only 9 podcasts,
Right. There were like 32 podcasts in the entire business section of iTunes. Because it was like so clunky and hard to use, and people didn't have podcast players, kind of thing. And so it was like, it made a huge difference for them, even though podcasts were at the like, I didn't know anyone else listened to podcasts. Like, I was listening to podcasts and I was like, oh, I'm listening to this podcast. People were like, what is a podcast? So I think it sort of set me on that path. And I've kind of always viewed that as sort of the hub, so to speak, kind of like that. That's kind of like the hub. And then I've branched out and kind of done these other projects over the
Yeah,
years.
your newsletter is still amazing. The interesting times I open all the time. Just like good links, summaries of things. I don't know. I just feel like, this idea that you have been refining is a really interesting way to look at the world, and it's kind of explains a bunch of events that you don't really expect to have explained to you, or certainly like not in the way that you frame things. So yeah, I've enjoyed it for a very long time.
Appreciate that. Yes, hopefully it stays interesting.
Yeah. All right. So what are the other branches that we go off from the newsletter? I guess what in your mind, what's the next sort of I don't know, inflection point maybe after that first book?
Yeah. So I guess kind of chronologically, part of the next inflection point was, so as I got interested in the crypto stuff, and I started writing about the crypto stuff in kind of early 2017. I remember, of course, like the interest always follows the price action, right? So I think towards the end of 2016, like Bitcoin dealt, it went from like 200 to 400 or something, and I like owned a couple Bitcoin. I was like, oh, that's cool. Like, what happened there? And so I got really interested, started reading a lot about it. And then, to become a crypto expert circa mid 2017, you had to like read 3 blog posts and you knew more than everything else, right? Like the bar was very low.
You had to actually read the white paper. Yes.
Yeah, right. Exactly. If you'd read like the Ethereum with the Bitcoin white paper, it was like top 1%. You know what I mean? You could do it in like a weekend. And yeah, so I started writing about that, and I wrote mostly about crypto stuff sort of 2017, 2018, maybe into 2019 as well, was when I was kind of like working on the book. So that was kind of like the next big phase for me. And so that was all the transaction costs and just thinking about how, and that was kind of, again, it's just like an extension of the same idea from the end of jobs, thinking about how this affects work and how this affects structure of systems, and all that kind of stuff. And then that kind of also led me into just investing and trading. I got really interested in finance. And I think you talk about complex systems like ecosystems or cities. And if you're like interested in that topic, like it's hard to find a more fertile sort of field of study than like markets, right? Like it's just, it's an incredibly complex, super dynamic, always evolving system. It's a really good lens to talk about the things I want to talk about because people like money, right? So if you can explain things in a way where like, this helps you make better financial decisions, that's very compelling. Yeah.
It's quantified in a way that, cities aren't, and contemporary in a way that, history and war isn't. So yeah, makes sense.
And so, yeah, so I got interested and I kind of wanted to do some more stuff in crypto or finance or something in that space. And I was working on my book, and then I met my now business partner, who basically had this idea for what became Mutiny Fund.
How did you guys meet? I'm always curious to hear those stories. I feel like people gloss over that a lot, but it's like a huge blocker for people who have not yet been through that. A good example of like leverage option. We was like through a friend on Twitter, basically. I co-wrote a post on stable coins with a friend of mine, and he read it. This is like 2018, I think. Wow, cool.
And so we started talking about stable coins. And then, anyway, he basically had this. I was looking at investing in a particular strategy that was the first kind of strategy we launched with. He had been trading that strategy, and we kind of connected over that and started talking about it, and grew out of that.
What was that strategy?
So it was long volatility. So I'll insert my financial disclaimer here that nothing we say is financial advice. Talk to your financial advisor. Markets are risky. You can lose all your money. But with
especially
that
with stable coins, yeah.
Especially with stable coins. Especially with stable coins. So the initial idea was, or the initial concept was a sort of very like Taleb-esque approach to long volatility, right? So it's basically a strategy where the goal is most of the time you try to like break even or just lose a little bit of money, and then when everything else goes down, you make a lot of money. And so all of a sudden now you're in this very fortunate position where everyone else needs cash and asset prices are depressed and you suddenly have a lot of cash. And so we got connected over stable coins because this idea of I guess just call it like diversification at the simplest level, or like stability through volatility. But if you can take different return streams, different assets, which are all volatile but uncorrelated with one another, and combine them, the return stream you produce is very stable, right? So the example I typically use of this is there's an approach called the permanent portfolio. This guy came out in the 70s, named Harry Brown. It's basically equal parts stock, cash, bond, and gold. And it's super simple, 25% each of those four things. You rebalance it once a year. And if you look at how that strategy performed since he came up with it in the late 70s, sort of the tagline is like stock-like returns with bond-like volatility, right? So you get sort of very close, very similar returns you would to an all-stock portfolio with much, much less volatility, even though the underlying components of that portfolio are volatile. And so that was kind of how we connected over stablecoins, and that was our sort of mutual interest in long volatilities. That you could take this negatively correlated to traditional assets thing, combine it with those, and you could produce a better portfolio. So our part of the initial idea was like we would use this to make a stable coin, right? We'd have this diversified basket, and it would be not stable to the US dollar or something, right? But relatively stable on like a purchasing power basis. So that was kind of how it got started.
And what is Mutiny Funds today? Because I want to like explore a lot of that stuff, but I don't want to skate over the setup for all of these different vehicles.
Yeah. So our first product was, as I said, basically a long volatility strategy. We're basically a fund to fund. So we invest in other long volatility hedge funds and aggregate them together. And again, it's we call it diversify your diversifiers, right? So if you have, instead of having, going back to the permanent portfolio example, instead of having these four big buckets, it's like, what if you could diversify within the buckets, and then you get more of the same effect. And so that was the first thing. And
so diversify within diversification. So that's like what within your 25% gold, you have like part gold, part nickel, part Bitcoin, part like sort of all of the, you split up within sort of the characteristics of gold.
Yeah. So I use like long volatility strategy as an example. There's a lot of different ways to trade long volatility. There's, I'm trying not to get like too super wonky here, but like you can trade like what are called like relative value strategies, where you're like using the VIX, which is the volatility index. There's VIX futures financial instrument. You can trade options. You can trade those options in many different types of ways. And so one of the interesting things we found when we were researching this space is you had a lot of these strategies that were uncorrelated with each other most of the time, but they all became correlated with each other in the correct way when you had like a major risk-off event. And so by taking them that were uncorrelated with each other most of the time and combining them, you could create call it like a ratchet-like effect, but basically improve your if you can do that, it improves your risk-adjusted returns. So like this is like a toy example or something, but it's mathematically possible. You could have, let's say, 3 assets that are uncorrelated, fairly uncorrelated with each other. They all have a 0% expected return, but if the path they take is uncorrelated and you rebalance between them, you will create a positive return. So like I think another example I was reading in a blog post recently, it's easy, is I think from like these dates are going to be off, but ballpark, 1962 to 1982, the total return on stocks was 4%, and total return on gold was 4.5% or something. But if you just like rebalance between the two every year, your return was 4.9%. So same underlying, you're selling two things, but because those things are uncorrelated and you rebalance between them, you can improve the risk-adjusted return. So that's, they talk about like diversification is the only free lunch in investing. Like that's the free lunch, right? You're not taking any more risk. You're owning the same two things, but your risk-adjusted returns, if those things are uncorrelated, ends up being significantly better. So that was kind of the organizing insight for how we structured everything. So we started with the long volatility piece, which tried to take that approach to long volatility of this thing that has that characteristic of it does well when most other things tend to do badly. But then having diversification within that basket. And then currently our main our main product is called the Cockroach Fund, which basically takes that to the next level, which is, so it combines, similar to Harry Brown's permanent portfolio, which was kind of our inspiration, it combines long volatility, commodities, stocks and bonds. So it's different in that it diversifies. So like, instead of using just gold as your commodities, we're trading 100 plus different commodity markets, right? So that, again, you have that same characteristic of there's not a lot of correlation there, and so you can sort of harvest that rebalancing premium while still serving sort of that fundamental role of commodities in the portfolio. And then you kind of ditto. Stocks and bonds are relatively easy to diversify with the advent of ETFs at this point. But sort of combining those all into a broader portfolio tries to get that better risk-adjusted return like you would from having these uncorrelated bets. So
this is something I remember. I think I've read all of Talib's books, at least the aside from the statistical, like incredibly math dense one. And I got really enamored with the idea of like long volatility and started to kind of drink the Kool-Aid of the complex systems. And I went down this path of like trying to figure out how to actually, like, as an individual retail investor, like place that bet. Like, I kind of wrapped my head around a long volatility strategy, and I still couldn't really figure out how to either access it or use it in the context of a broader portfolio. Because, like, I think and please, like, correct me if I'm wrong anywhere along here, but like it is at least used by hedge funds as a small fraction of their strategy, so that they are sort of balanced against some crazy event. It's not like they have a big chunk of it, and I just couldn't figure out how to access it or how to like fit it into the rest of the portfolio. So how do you see this strategy like fit into everything else?
Yeah, so that's kind of part of the reason we started, right? It is there are funds that specialize in this. As with most hedge funds, the minimums tend to be somewhere between $1 and $20 million. And if you want some diversification, you're going to write $3-5 million checks. And then you don't want it to be all your portfolio. Let's say you want it to be a quarter of your portfolio. So now you're talking about you have to have $60 million to be able to like put this in portfolio and size it appropriately. And so that was kind of the problem we were solving with the long volatility. Is like, we would combine these at our level, and we could give much smaller retail investors or non-institutional investors access to these strategies. So yeah, it is super hard. People do try and trade this themselves. You can do that. It's really hard. I try to do it. We've been down that road. But the people that are doing that fairly successfully, right, are quantitative teams. With 3 PhDs on there that have like a robust order system and all this sort of stuff. So we feel it is one area where active management still is justified, right? It's not something that's like super retail accessible. And then in terms of like how it fits in the portfolio, it's interesting. I think part of the reason the strategy has worked historically, in my opinion, is it kind of like sucks as an investor because you mostly lose money. If you've read something like Taylor Pearson Weinstein's book, where he's like, you're just so sick of like explaining to all these investors, they're like, oh, well, we lost money in a month. He's like, yeah, you're going to lose money like 99 out of 100 months. Like that's how the strategy works. Yeah. And that is how the strategy works. And you could do some things to try to mediate that. But if you look at it, it's most investors, I think this is like one of the biggest mistakes investors make, is they look at their portfolios as a series of line items. And they want to pick the best line items, right? And so, like, this is how you get into return chasing. Like, I own these 10 things, and these 3 things went up the most last year, so I'm going to buy more of those things. And really, you should think about the portfolio holistically of, how do these things interact with one another, right? So the idea of long volatility in the portfolio is, even if it has 0 expected return, over a 10-year period, it makes no money. If it makes money when everything else in the portfolio goes down, it allows you to rebalance at the optimal time and basically buy everything else when it's less, and then use some of those profits as those things go back up to get back into the long volatility. So it's that rebalancing effect that creates the sort of whole is greater than the sum of its parts dynamic.
And the goal that it serves, is something I've seen. I think I've seen you write about a few times, like the 1,000-year portfolio or the 100-year portfolio. Like it is extremely like it is geared towards people with a very long-term view and a very low, like not active investors. Like it feels like almost the level up from a passive index of like, just be a little more deliberate with your portfolio construction and think about a very long-term time horizon.
Yeah. I mean, yes and no. So like, I think, there's, if you look at this is like a super standard thing in finance theory. They have this idea of like the efficient frontier, right? So it's like, what combination of these assets gets me the most return per unit of risk? And usually risk is defined as volatility, which I have some issues with, but we can sort of brush that aside. But just thinking about it basically as like return per unit of risk. So the optimal portfolio, or sort of according to this theory, is you want to get the best risk-adjusted returns, and then you want to apply leverage to get whatever your return targets are. So it's just the best risk-adjusted returns is this much stocks, this much bonds, this much gold, which you want to get higher returns. Well, then you use a little bit of leverage, and you do that. In practice, so you kind of have two ways of getting higher returns. You can either take leverage risk, right? You can have a diversified portfolio that uses leverage, or you can take concentration risk, right? You can buy super risky assets that might go up a lot, and but super concentrated in tech stocks and whatever, and kind of the financial theory, everything suggests that having a highly diversified thing and using a modest amount of leverage is a better long-term risk-adjusted return than taking a lot of the concentration risk. And so that's sort of the approach we take. And I think a lot of people, I think the strategies aren't super popular because people don't like volatility because it usually loses money. And people don't like, people generally seem to prefer concentration risk over leverage risk. But all that to say, I think it's, I think a lot of times it's like, oh, well, diversification is like, that's something I do if I'm like be conservative and I'm going to be safe and I'm like not going to try and do super well. And like, if you do like, it's mathematically just not correct. Actually, it is a log wealth maximizing strategy. There's this whole idea that's like the Kelly criterion and bet sizing that was developed by was his name Ed Kelly? Ed Thorpe was the one that kind of like popularized it, but he was an engineer at Bell Labs, and he did it with blackjack initially, was I think where he sort of developed. But basically, the idea is if you have a coin flip and you have, let's say you have a loaded dice, and let's say you have a slight edge in the loaded dice, how much of your bankroll do you want to bet on the dice? So you're cheating, right? So you have an edge, but you could still be wrong, right? So let's say that six on a dice should show up 16% of the time, and you load it so the 6 is going to show up 25% of the time. So you have a meaningful edge there. But if you bet everything you have, you're still going to be wrong 3/4 of the time. You lose everything. But if you don't bet enough, you're hurting your long-term gain. You could be betting more to take more advantage of your edge. So he solved that if you know your odds and you know your edge and you know your odds, you can calculate the mathematically correct size of your bankroll to bet. And so that's kind of, in theory, that's what sort of more diversified approaches, like what we do, are trying to achieve. In practice, it's never, if you look at like really diversified portfolios, they just do okay all the time, which is like not super cool, right? Like it's never the best returning thing. We joke, it's like we try to build the least shitty portfolio we can.
Yeah.
Right. And that, mathematically, if you look at that approach, it should be the best sort of long-term wealth maximizing approach. But over any given day, month, week, year, it's going to underperform something, right? Something else that has more volatility is going to do better. So anyway, yeah, it's a long rambling answer to your question, but to your earlier question, that's kind of the idea.
So you said it's been, you have said it's not super popular, but who has it been? Who is attracted to this? Who is using sort of the long volatility strategy, and how are they using it?
So I would say, I think there's one category of people that we don't super try to encourage. It's like the perma bear crowd. There's one of my one of our back office partners has this idea of the white moose. So the white moose is the opposite of the black swan. The white moose is what happens when you keep betting on the black swan and it never materializes and you just sort of get chipped away. So you need to have black swan and you need to have white moose, right? You need to have things that have that long volatility profile or sort of crisis assets, but also things that just do well most of the time and are just kind of like chugging along. So one category of people is people that are just like are using it as a bet on the end of the world, which I don't think, my opinion is that strategy doesn't work very well because the world usually doesn't end, and if it does, then we all have bigger problems. But I think the other group of people are just people who understand more or less what I just explained, which is, okay, this thing as a standalone investment is bad, but I own a lot of stocks, bonds, private equity, venture capital, etc. All those things, if you have a major risk event, tend to be correlated with each other, right? They all tend to go, if you look at 2008, all those asset classes went down. And so having something else to diversify that with that I can rebalance should improve the overall returns of the portfolio. And so I think that's kind of the core idea.
Okay. And let me see if I can recap a little bit. And again, please correct me if I'm wrong, but Mutiny Funds is a fund of funds that creates a sort of anti-correlated asset with the things that most people own, which is like stocks and bonds. So if you invest in Mutiny, that money ends up split among a handful of hedge funds that are actively trading a long volatility strategy, which I want to have you explain like how that actually works. So that, if what just happened this, a month ago happens again and all the tech stocks that you own go down by 80%, this other asset you've invested in through Mutiny goes up by, I don't know, 3x, 5x, 10x. Like I've seen some absurd numbers come out of some of these hedge funds that are like appropriately positioned for crashes. But can you get into the details at all of like what those hedge funds that you invest in are doing? Like what does that strategy look like day to day?
Sure. So we have one fund that does that. It's a fund of funds for long volatility, and then we have another fund that invests in the long volatility fund and also does the stocks, bonds, and commodities pieces. That's sort of our total portfolio. That's the Cockroach Fund.
So that's kind of the if you want Mutiny to execute the whole strategy, you can just go in that, and if you want to do your own rebalancing portfolio, then you provide just that one kind of pure anti-correlated asset.
Correct. Yeah, I guess part of the reason we launched the Cockroach Fund is because no one actually rebalances, or in practice people don't. And so doing it all in one place seems to work better. I can go into totals. Yes, correct. We're functionally a fund of funds. We're technically called commodity pool operator. So we have different funds we work with. Most of them we have what are called SMAs, separately managed accounts, where we basically grant them limited power of attorney to trade on our fund's behalf. And then we're monitoring their trade and what they're doing. Within there, we have basically three different sub-strategies or different approaches to long volatility. The core of what we do is our long options bucket. And so that's that's the purest expression of long volatility. They're basically going out and they're buying options and those options should have a convex payoff profile, right? They're going to lose a little money most of the time and hopefully make a lot of money a little bit of the time. And then I guess I could just briefly to explain what an option is. You can stop me if this is old hat for people, but an option is sort of a bet on the future. It's the right but not the obligation to buy or sell a security at a specific price in the future. So Functionally, for long volatility strategies, you're using put options, which is basically a bet on the market going down, sort of akin to like insurance, right? So you say, I'm going to buy the S&P is at 4,000. I'm going to buy a put option for 3,800, and if the S&P goes below 3,800 over whatever time period I specify, let's say a month from now, I earn some amount of profit on that option, and that's vastly oversimplified, but that's the basic idea.
And you're paying a few dollars, like as a percentage of that. You're paying like a small fraction of what you could earn if that event happens, right?
Yes. So options there's what's called the option Greeks. So one of the primary Greek is called delta. So a given option has a different delta. So a deep, you can cut me off. I can go as long as you want.
I'm going to need a whiteboard. This is
I gotta get
the 301 course.
Sheldon Nateberg, Option Volatility and Pricing, is on my back shelf. That's if you want an introduction, that is the definitive text. So when an option is deep, so let's say I'm using my example. The S&P is trading at 4,000. Let's say I buy a put option for 6,000, right? So the option is deep in the money already. I'm betting that it's going to be below 6,000, and it's already at 4,000. So at that point, a $1 change in the underlying, the S&P in this case, tends to create a $1 change, or very close to $1 change. It's a 1 delta option, effectively. Because you think about it, like it makes sense, right? The S&P goes down by 5%. Like it hasn't really changed the probability that that's going to finish in the money, right? Like you're very deep in the money. Now, if you go on the other side, let's say I buy S&P's at 4,000, I buy a put option at 1,500. It's way out of the money. That's going to have a very low delta, because if the S&P goes from 4,000 to 3,900, it's still probably not going down to 1,500, right? The probability of it going all the way there is a lot lower. So there's a second order Greek called gamma, which is the delta of the delta, effectively. And like that deep in the money option is going to have sort of like different gamma properties than the far to the money, but the basic idea is options are going to have different amounts of convexity, right? So certain, like a deep out of the money option is going to have the properties you can, like if I buy the 1,500 S&P call, S&P put, the S&P 4,000, and the S&P goes down to 1,000, I'm going to make 200x. There should be some very high return, right? Because it was very deep out of the money, but other options aren't that way. So the long answer to your question, but yes, there are different sort of payoff profiles with options that you can customize.
Maybe the bigger the Black Swan, the bigger the magnitude of the event that you're betting on, the less you are paying for how much you earn as an outcome to that.
Yes, generally that's true. There's a bunch of caveats about transaction cost and that kind of stuff. But
I was trying to oversimplify, so I'm glad that there was a caveat necessary. Just to re-summarize. Okay, so that in that, I mean, all of this complexity is why these are still actively managed funds. Like there's the hedge funds that you're investing in are actively like seeking good deals on these options all the time and constantly refreshing and stacking layers of different options and trying to figure out like how to cheaply manage the strategy so that they still have a great payoff if things go down.
Right. So the way you usually look at options prices is they form what's called a volatility surface. So we'll stick with our example, like the S&P at 4,000. You have puts and calls. Talking about puts, but calls are bet things go up. Puts bets things go down, and then you have different strike prices, which is the price structure. So you could have, we talked about the 1,500 put or the 6,000 put, and then you have different expiries. So one option could be a 1 week expiry. It has to go below 1,500 in 1 week, and that's the specific bet you make on that option. Another one could be it has to go above 4,200 in 6 months. Right, and so if you can plot all these things three-dimensionally, and it forms a volatility surface. Like kind of if you look at like a geographic or topographic map with like a mountain, it kind of looks like that, right? Like it's sort of like ridges and moves. And so functionally, what most of these managers are doing is they're looking for what what their sort of proprietary algorithms, experience, et cetera, are the relatively cheap parts of the volatility surface, right? So say, oh, well, this option for, the Chinese yuan, blah, 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 looks relatively cheap compared to this other option, and I think it has this sort of payout profile. And so that's relatively attractive. So they're all, for the most part, the hedge funds who do this are doing some form of that, right? They're looking at the volatility surface and trying to look at what are the relatively cheap parts and what are the relatively expensive parts.
Yeah, interesting. Okay, so the other thing that when I was reading more about this, and this is a few years ago now, because it was before Mutiny Funds existed, and I was just like, why is there not a resale accessible version of this? And then I just kind of gave up. But I was reading about, it seemed to me that there should be a simple enough strategy. I was like, why isn't there like an index fund for this? And then someone was like, have you heard of the Vix? I was like, no. And so I went and it's like, oh, this is an index for this. And then every single article I read about it was like, do not invest in the VIX. It will eat your face. This is a terrible way to execute this strategy. Don't do it. I don't know why anyone does. What is, because that's what you're like competing with basically, right? Like that's the other option that's accessible to retail investors. What is wrong with it? What is it? How does it work? And what's wrong with it?
Yeah. So the most common so VIX stands for Volatility Index. If you pull up, Y charts, whatever market dashboard, you can look up the VIX. You can see what it is at any given time. It gets called the fear gauge is the general idea, but it's a calculation based on various option prices, S&P option prices that get fed in. And generally the way it works is if people are worried about bad things happening, they're willing to pay more for options, which means the VIX goes up. People are less worried, they're willing to pay less for options, the VIX goes down. The biggest misconception about the VIX is that, so you actually cannot trade the VIX. It's an index. There's no, if you think about no, you can't trade the VIX because no rational counterparty would ever take the other side of the trade. Because typically the VIX stays at a certain level and then only goes up. It never goes down below a certain level. So the CME, the Chicago Mercantile Exchange, developed VIX futures, and VIX futures forms what's called the Vix Curve, but it basically has different expiries on the VIX. So as an example, the standard the standard structure of the VIX is, let's say the VIX index is at 20 right now. 1 month out, the futures contract for the VIX might be at 22. So there's a month between here and there. Something bad that we don't foresee could happen. So people are willing to pay a little bit more. And then over that month, either something bad is going to happen, the VIX goes up and the price of the futures converges with the spot, or nothing bad happens, and the price of the futures falls. And you have, I think it goes out 9 months. I can't remember how many months out the expiry goes. But the general structure of the VIX is, it's a little bit higher every month, right? So it's 21 1 month out, and it's 22 2 months out, and 22.5, and so on. And then if something really bad happens, the shape tends to invert, right? So now the VIX is at 50, and it's well, some crazy stuff has happened, but we probably can't keep doing crazy stuff forever. So the next month is 45 and 40 and so on. But your question about trading the VIX, yeah, I mean it is. It's extremely volatile, right? So it's very easy to get your face ripped off if you don't know what you're doing. It's very easy to get your face ripped off if you do know what you're doing. You have to really, really know what you're doing. But the typical challenge with a lot of passive volatility strategies historically has been they lose so much most of the time that even when they do well, it doesn't compensate. Right, so you do have to have something that loses a little bit but then makes a lot is okay, but something that loses a fair amount and then only makes back a fair amount, it doesn't really work. So most of the historically, if you look at just a naive approach to there are various ETNs and stuff that do this. It's just hard to make the math work. Where yes, is it negatively correlated? But it just loses so much most of the time that it doesn't really work.
Yeah, I mean the I mean, back to the transaction cost idea, right? Like, it has to outperform by enough, and the same is true of the fees involved in some of these funds too, right? Like, they have to outperform their own fees in those sort of adversarial environments, which I'm sure is part of the math, right? Like, does that add anything? I don't know how the fund of funds things works. Like, do you get negotiating leverage over the hedge funds that you work with so that it kind of nets out for clients, or is it like fees on fees?
Yeah, both.
Okay.
Yeah, we do get some negotiating leverage, but obviously we assess a fee at our level as well. So yeah, I guess the reason we started this is we looked at net of all fees, what is the best solution, and like we think net of all fees, an ensemble of active long volatility hedge funds is a better solution than passive approaches. But it is, yeah, we can do a whole conversation around passive investing and what that makes sense or whatever. But like, it's not, if your goal is to like minimize fees, you're probably not ending up in long volatility. But if your goal is to maximize risk-adjusted returns, then it might make sense.
Yeah, I mean, as far as I can tell, there is no non-fee way to access the strategy, really. I mean, you're the first person, or the first way that I know of for retail to do it at all, and the hedge funds are doing essentially the same thing and still outperforming in a lot of cases. So
I mean, there are various ETFs and ETNs, but as I said, historically, it just hasn't worked super well as a passive strategy.
Yeah.
That's kind of the conclusion we came to.
Interesting. Okay. Are there future products in the funnel for Mutiny, or you feel like this is the suite that you wanted to do, and now you're just sort of executing and growing?
Yeah, I think our vision was always, I talked about like the permanent portfolio, and like our sort of Cockroach Fund is like our implementation of that we feel like is a more modern and robust version. We're just using tools. Talking about long volatility hedge funds. Really, the VIX wasn't like tradable. Like, there wasn't enough liquidity to trade the VIX until like 2010. So it's really only been around for 10 years. I think the oldest fund we invested in started in 2012, right? And that's like ancient. And the long volatility world, like most of the funds are much newer than that. And there were some funds before that in like but it was historically been just like a very niche strategy. So
Universe is kind of like the classic in this sense, right? So the one that
Universe was the firm Taleb was associated with. They've been around. One of the. I can't remember how long they've been around. Maybe since the 90s or something. I don't know exactly when they started with, but they're certainly one of the older ones. Most of the older funds tend to have very high minimums. So most of them work exclusively with institutions, right? Like, I think there's articles in March that like CalPERS, the California Pension Retirement, was one of the big Universal clients, which ended up pulling out and missing out on a bunch of. I think they pulled out in like January, and they would have made $1 billion if they'd stayed in through March. But most of the older funds that I'm aware of tend to service like large institutional clients.
Oh, that's amazing. So the CalPERS is one of the biggest, I think, pools of money in the world. It functions still exactly like you described a retail investor, of like looking at them all as line items and pulling out at the exact wrong time, losing patience.
When we started this, I was like, all these institutional people must be so smart and everything. And, broadly my takeaway has been people are people. And sort of the same psychological we have retail investors we talk with that are super savvy and like really understand everything, and institutional people that you're like, did you find your money in a bag in the alleyway? Like, how did this work? So yeah, just people are people.
Yeah, so I mean, it's your job, from what I understand now, to evaluate hedge funds and sort of assemble this super team of super people who are going to execute. I'm sure there's layers to the evaluation of what's the strategy, what's the approach, how's it executed, who are the people, but sort of what is that process like for you? What do you look for in the hedge funds that you assemble?
So one of the first things you want to know is how it we kind of look how, again, we always start from this like sort of holistic portfolio view. So we always, in the context of long volatility specifically, we want to look at like how it compares to the other managers. So I mentioned, so we had 3 different buckets. The one I mentioned was long volatility. We have another one that's called Volatility Arbitrage, and it's going long and short volatility. Again, trying to find the relatively expensive volatility and sell it in the relatively cheap volatility and go long it so that it can make money in both up and down volatility environments. And then we have a short futures bucket. So all those, and then within each of those buckets, there's diversification, right? So there's different ways. If you're going to trading a lot, you can trade at the money, you can trade near the money, you can trade deep out of the money, you can trade short-term expiry, you can trade long-term expiry. There's a bunch of different ways to trade each of those strategies. So the first thing is, does it have some wrinkle, right? Are they doing something unique, something different, something from other managers in our portfolio where, that sort of has 2 big advantages in our view. One is it creates something else uncorrelated, right? So it's like we're adding another uncorrelated return stream into the portfolio. And it also covers like another path dependence. So like when we talk about portfolio construction and we're like looking at the portfolio, we basically like never talk about like, I don't want to say never, but like the conversations are not framed as like, oh, I think this thing is going to do really good. Because our honest thing is like, we don't know and we don't think anyone knows. Certainly at like a macro level, what are stocks going to do, all that kind of stuff. We want to look at like, does this cover some path that is not covered by the rest of the portfolio, right? Does this cover some contingency, some black swan or some white moose that the rest of the portfolio doesn't cover, right? So again, like this idea of sort of building the least shitty portfolio, right? We want to cover as many of these possible path dependencies as we can, so that sort of however things play out, it should do pretty good. So that's sort of the first thing, and then after that, you get more into just like, I guess, operational and technical due diligence of, are they doing all the regulatory things, and do they seem like they know what they're doing, and do they have a track record, and that kind of stuff.
Cool. That sounds interesting. Tough, but interesting. How long have you been building up this core of knowledge? I mean, this all seems so detailed and arcane I've read a fair amount about this, at least at a high level, and it's still like I've only understood like 40% of the last 20 minutes, I would say, with like high conviction. Yeah.
Which speaks to how well I can explain it, which is not that good at this point, but I'm working on it.
No, I mean, like, I get it, but I understood the example that you were giving me, but I know that there's a lot of depth to the idea that I just don't grok in the way that you do, who's been thinking about it. Yeah.
It's interesting. I'm working on a white paper on like diversification, which like diversification is like the most boring tried topic in like investment, right? Like everyone's read something about like diversification being good, and like my opinion is like almost no one actually gets it, right? It's just like you pay lip service to it, but like no one actually gets really the underlying why it's so compelling and that kind of stuff. But it's hard to do in a podcast. I don't know. You got to have some graphs or something to.
Yeah, absolutely.
Make it make sense.
It's one of those things that everyone tries to do, but then kind of like points at themselves for doing poorly. Like we were all really excited that crypto was going to be like this non-correlated asset class, and we would be able to diversify into it. But like it basically so far seems to perform almost the exact same way as tech stocks, which may or may not be reasonable. It may or may not turn out to be true over the long term. But then there's I don't know. I'll be interested to see your take on it, because I feel like it is one of those hotly debated things. It's interesting to hear you describe it as like a dial with sort of concentration risk and underperformance risk on either side of it. So I was like the Munger idea of like, you know, the more you know, the less you diversify. But I don't think I think he's talking about owning a few good companies, not, a 100-year portfolio of like, if you were in a coma, it would still outperform.
Yeah. And I think Yeah, you can go back. If you just like take Berkshire stock and you like combine it with some commodities and like some other diversifiers, it's better. Like because those things are uncorrelated to the Berkshire. Right? So I think even if that, some people it's like, oh, I'm really good at, what I want to do this specific area of investing. It's like, cool, do that and like really go focus on that, and then like diversify the rest of your portfolio to enable you to do that. And I guess that's maybe to get back to sort of the genesis story of this for my partner was he was a real estate developer in the 2000s, and he was a good real estate developer. But when 2008 hit, and it didn't matter how good of a real estate developer you were, right? Like if there's a macro crisis that hits your industry, like my wife worked for an events company. It didn't matter how good of an events company you were in March of 2020. It's totally irrelevant. You could have been the best events company in the world. Your revenue went to zero.
Yep.
And that was sort of the nature of it. And so that's kind of that's how we think about it. Right? It's like, go find your thing that you're really good at and like spend your time and focus on that. But I think most people tend to be like, I run an Amazon business, so I understand Amazon, so I also invest a lot in Amazon stock. And, they end up like triple levered to like one very specific sort of bet, which when it works well, works really, really well. If you're extremely levered to a very concentrated thing, you're going to have high volatility in your returns. It could be up, it could be down, but you're going to have high volatility returns, and high volatility tends to hurt in the long run because losses hurt more than gains, right? So a 5% loss, you only need a 5.3% gain to get back. But a 50% loss, you need a 100% gain to get back. 75% loss, you need a 300% gain to get back, right? There's it's not one-to-one. The losses hurt more. So that's kind of how we think about it.
How do you know, and this may be more of a career question than a portfolio size question, but either answer would probably be interesting. How do you know when to kind of shift focus between, hey, I need to be more in, I understand this thing really well, I would need to exploit it maximally mode, versus I'm in wealth preservation and like slow growth mode, when you start to think about some of these things that are more portfolio construction and loss aversion, instead of like just executing and the things that and can control.
Yeah. So I get my quick thing, but I think that's kind of a false dichotomy. But I come back, the optimal long run portfolio is always to have the most efficient mix of assets, and you could include assets as your skills, your network, right? We could lump all those things in there as well, and then to sort of lever them in the appropriate way. So I guess it's kind of never too early to like think about the diversification component of it. I think just from like a pragmatic finance, I don't know, if you have like $200, would you think about like what hedge funds to invest in? Like probably not. You know what I mean? Like there's some financial threshold or something where there's enough assets that think about it that way. But like even I just finished reading. I read last year. It's a book called The Origin of Wealth. Which I've
read bits and pieces of it. I haven't done cover to cover, but I really liked it.
Right. But and a bunch of other books talk about this idea of like thinking in bets, or like applying portfolio strategy to your life. Right. It's like one of the examples it gives is Microsoft. I'm trying to remember the exact story, but Microsoft basically had like Windows was one of like 6 different projects that Microsoft was running in parallel, because like they didn't know what was going to work. So they were like doing MS-DOS, and they were doing Windows, they're doing all this other stuff. And so like it gets reported, like these stories get reported like, oh, this brilliant person saw that this was the future and built the thing. But like really, I think that you look into all these stories and it's almost always the same thing. It's like these companies that last, it's like, no, it was like super hedged. They're like, okay, there's 6 possible ways this industry can develop. We're going to have something for each industry. We're going to see what takes off. We're going to put assets behind that, that kind of thing. So I think you can apply that same sort of like logic of diversification, all that stuff, to other things you're doing, right? Which is like, how do I sort of have a portfolio of bets, and what does that look like? So yeah, I don't know. I think when it comes to your time, like you do functionally get like I don't know, I guess you run into like a transaction cost. Like you can't work on like 7 businesses at once, right? Like you end up, it
I've
doesn't
tried
work.
it.
Like,
It's very
you can't
hard.
switch between the 7 things, and it's very hard. So I do think at a certain point, like you do need to sort of like focus your time on one thing. And then I think honestly, like, for a lot of people, it's like they're not trying to do like the long-term wealth maximizing thing. They're trying to do like what they want to do with their life. It's fun and whatever, and like that's cool, like that's a viable.
Okay, this is a question that I'd just like to ask a variety of people, and I feel like you might have a good answer to. Since you're very, I don't know, a theme of a lot of what you talk about is like the long game, the long perspective, focus on compounding. I'm always on the hunt for who is playing the longest possible game, and just like more and more examples of people who are thinking over like decades or even generations. Are there like heroes in your life or people that you've read or investors that you've studied that are really good examples of playing an absurdly long game?
Yeah, I mean, obviously we're trying to do that. I'm trying to think of other. I think like the story of like Ed Thorpe is really interesting. If you look at like he sort of like took the Kelly. There's actually one of like I would love to write a book on like alternative histories of like different things happening. So Ed Thorpe was I forget exactly his relationship to Kelly, but he was like one of the early practitioners of the Kelly Criterion. He had a hedge fund. I think he lived in Newport Beach, California. But it was like. I think the hedge fund, I'm going to miss some of these, but the hedge fund was running for 15 years or something. And he was like smoking Warren Buffett. And basically his partner ended up engaging in all this fraud. The fund got shut down in like the late 80s and like it never went anywhere. And like I do want to do this alternative history of like, if he was like still around today, like would we talk about Warren Buffett or would we just talk about Ed Thorpe? Because like he actually performed I'm trying to remember. I'm saying he was smoking more. I don't know if that's really true, but he was performing extremely well over an extremely long period.
I think this is the second podcast in a row that Ed Thorpe has come up.
And so yeah, I think he's an interesting example.
I was just talking to David Senra about him too. He's just like I think he restarted with a separate fund that was smaller. But like got his own track record. There's just like he worked on a computer with Claude Shannon when he was like trying to do roulette. Like if I remember, it's a wild story.
He has a crazy story. There's a book called Fortune's Formula that's like a really good. It's like Thorpe and Kelly.
A Man
and
for All
those
Markets
guys.
is his book, right?
It's a super interesting read.
Okay.
Yeah, that's his like biography one. Yeah, I think my sense is like when the fund closed down, he'd like already made an insane amount of money, and he was like living in a mansion in California. So I'm like,
I'm good.
Okay.
Okay, so what is the long game for Mutiny? How do you see this playing out?
Yes, I mean, I think the way we think about things is it really isn't like we're talking about like the portfolio and stuff, like 100-year timeline, right? It's like okay, we can invest in this thing. And if this thing is going to blow up in the next 100 years, like that's a non-starter for us. Like that's too, we don't want to take that sort of concentration risk or that sort of risk. I guess that's like the frame we tend to operate in. Trying to like build that into like how the business is run, how everything is operating, making the parts redundant. I'm a big like SOPs guys and procedures and all that kind of stuff. So that's kind of like a big part of how we operate. But I think sort of our broad view of things is people tend to have short memories. People tend to look at what did well over the last year, 3 years, 5 years, 10 years, and things tend to get concentrated into those assets, and then things change. You have these phase shifts in markets where dynamics change, and so having this broadly diversified portfolio is effectively allowing you to capitalize on that, right? You own some of the thing that is doing well and outperforming, and as it's going up, you're selling some of that and buying the thing that is underperforming in the belief that at some point the story is going to reverse, right? And so I think commodities are like a good, like commodities did so bad. Commodity trend is sort of the standard approach to a common approach to trading commodities where you're looking for commodities with strong price trends and you're going long or short them. And the strategy did really well in 2008. It was like, it got built. Its crisis itself was really terrible. It was exciting. And then from like 2010 to 2020, basically, it just sucked. It went nowhere. Everyone hated it. No one wanted to do it. And then I think sort of starting late 2020 to present, we've all seen the commodity stuff in the news, oil prices, blah, blah, blah. It's doing great. Right. And, our view is did we predict that? Did we foresee that? No. Right. But that tends to be how the long stretch of history goes, right? You have these rotations between assets that come in and out of favor. And so the optimal way to do it, in our view, is to have a balanced portfolio with exposure to all these different pieces.
When you're rebalancing these, are you just kind of betting on a reversion to the mean, basically?
Yeah, I kind of. I think there's a good. I'm trying to think of what people can Google. If you look the permanent portfolio is a really interesting way to look at it. If you look at you can Google examples like the history of the permanent portfolio and how the individual pieces perform versus how the underlying pieces. And if you look at the individual pieces, they're pretty gold's pretty volatile historically, stocks are pretty volatile historically, bonds and cash not so volatile historically. But the combination of all of them, it looks like it's just a straight line. It's just this really smooth straight line. I think it's if you run all these model portfolios, I think it's the only thing that had positive returns in each of the last 6 decades or something.
Right.
But it never shoots the lights out. You're never going to make 50% in a year with the permanent portfolio because you're super diversified, right? But you're also, the hope is you're never going to have a 50% drawdown either, like you would in a more concentrated portfolio. And so, that's from a portfolio construction perspective. That's how we think about it, right? We want these diversified and correlated things with different return drivers that can combine to form a better long-term.
This is a very
growth rate.
Over and over again. I feel like I've heard you say something most people think X, we think Y. How have you cultivated and how do you entrain that unique mindset to kind of hold your line and your set of beliefs when the world is kind of shouting something else at you every day? I feel like that's a very unique skill. Yeah.
I do think I have a very high degree of I think in 99% areas of my life, I just kind of go along with it. You know what I mean? It's I have contrarian ideas about very few things, right? There's just a couple small things that I focus on. I'm not sure I'm particularly good at that. I think in this specific instance, there's a lot of things, I guess, probably like you and probably most of your lecturers, I'm curious. I want to figure things out. And I think with this sort of thing, I just kept trying, I'm always just trying to prove it wrong. I'm always trying am I wrong about this, right? That's always the paranoid concern in the back of my head. And I'm talking to all these people that are, what do you know that I don't know, right? I love that. There's that famous scene in The Big Short movie where he's in, he's trying to find his counterpart. Michael Burry that Steve Carell plays is trying to find, or no, it's not who is it? Steve Carell plays. I forget the guy's name. But he's trying to find his counterparty on the trade, right? He's shorting all these mortgage bonds and he flies out to this conference in Vegas and he meets, it's this guy, his counterpart is this guy in New Jersey who is a total douche and is not taking care of his investors. And so as soon as he finds that out, he's I want to load up on this trade as much as possible because now I know who I'm trading against and the guy's an idiot. Right. And so it's I'm always who's the other person, right? Someone's taking the other side of the trade and do they know something I don't know? And so I think that's kind of the constant thing, right? Who's taking the other side of this trade? Why are they doing it? Do they know something I don't know? Where does that go? And so I think in this instance, it's I've been asking that question and trying to get to the root of it for 4 years. And I just have, I think the answers are most things is it's people tend to look at their portfolio as a series of line items. They don't like that this one thing goes down. They want everything to go up at the same time. So I think some of it's just I guess call them psychological biases or just sort of decision tendencies.
I think that was a part of The Big Short, if I remember right, too.
That kind of thing.
Part of the short thesis was the people on the other side of this trade don't want to imagine what this failure is like, because it's painful. It is like conjuring up an apocalyptic event, and then you have to believe it enough to bet on it. And there's very few people that can psychologically like do that.
Yeah, and I think even like I use the Big Short's not the best. There's actually an interesting follow-up paper that looks at like how the Big Short funds performed after the Big Short, and they all kind of did bad. So it's like it goes back to the white moose kind of thing. It's like you can't bet on the bad thing happening all the time. You sort of need to have both those things. But yeah, I think like a lot of it, I think it's just like a short-term memory, right? It's like
especially.
No one remembers. Like I gave the commodities example, but like
especially for negative
like
events,
what's been doing well.
Every time I get in my head that like something did well, and then I go back and check, it did less well than I thought it did. That I had been like telling myself in my narrative in my head, my entry price is always higher than I remember it if I don't check it. Like always.
Yeah.
Okay. Last question. I feel like I've learned so much about all of these things. What is the mental model, or like aphorism or heuristic, that you think you reference the most frequently?
Reality has a surprising.
That is a very good one. I think I got that from you. I use that often. Yeah,
there's a guy. I think there's a software engineer that wrote a blog post, and I loved it. I wrote another post about his post, but he coined the term. I think his name was John Salvatierra or something. I can't remember. But yeah, there's a good example I use is like, this is actually a fun thing. If like you can do it after the call or so, take out a piece of paper and like try to draw a can opener, like how a can opener works. Like this is the handle, this is the blah, blah, blah. And you're like, that's a can opener. How complicated? I use a can opener all the time. It's so simple. Try to draw it. You can't do it. It's super hard. You will not be able to draw a functional can opener. The way the gears intersect with the handle and the pins that go into the gears. And like a can opener is like the simplest thing in the world. There's like 5 pieces to the whole thing. And so like as soon as you get into anything else, right? How to run a business, biology, your health, whatever, it's like infinitely complex. And I think I'm constantly reminding myself and trying to remind others to have some humility around that respect. Right? I think that comes out, this comes back to the antifragility and, it's what the famous Mark Twain line of, it's not what you don't know that hurts you, it's what you know for sure that just ain't so. Right. And so if you realize that you don't know very much, you can avoid a lot of those things that, really get into you. So I end up talking about it all the time, and I'm sure like, my God, this work project, this will take like a week. I'll just like knock this out. And it's like 2 months later, I'm like, holy crap. There were so many details to executing on this thing. And it was way harder than and that happens over and over.
I love it. So and the more outside your wheelhouse you are, the less of those details are going to be there going in. And the expert is the person who knows where the details lie and how to navigate them. I've used that idea a lot. I remember reading it in your blog post, and I think went back and read the original that you linked to, and it's an exceptionally helpful, and to your point, humility-inducing idea, which is something that's good for all of us. Thank you so much, Taylor, for taking the time and at least attempting to teach me some things that I wish I understood better. And I'm very glad and grateful that you are building Mutiny Funds, because I think it's something that the world needs. And it's just exciting to catch up and see what you've been working on. Appreciate you taking the time.